Good morning. We're going to get started here with the next 28-minute panel. We're going to review with the group ideas of which investment strategies within the private capital markets the panel views as the most compelling. The organizers use the word hot. We're going to interpret the word hot as not money flowing into it, but which strategies are most interesting from a return perspective over the next 3-year cycle. So that'll be question one we'll get into. Question two will be which strategies are not hot, which are cold, which are going to potentially flounder and not reward limited partners with extraordinarily fine results. So my name is Ralph Money. I'm a managing director and member of the investment team with Common Fund Capital. We manage about $14 billion of assets around the world in the areas of venture capital, private equity, and private energy and natural resources strategies, and thrilled to moderate this panel. We're going to do a couple things. We're going to ask each panelist to introduce themselves, their name, briefly share what their firm focuses in on, and then tease us with an initial investment strategy that they think will be hot or compelling the next cycle. But before we dig in with the panel's self-introductions, just a really quick show of hands so the panel knows who we're talking to. If you're a GP, can you just raise your hand for a second? And keep your hand up if you're raising money. You're lying. You're all raising money if your hand's up the first time. You should always be raising money. And then the limited partners in the group, if you can raise their hand, please. And you're always thinking about thoughtful investing, looking to make a large amount of money for your organization. And any placement agents, media, third party, not GP, not LPs, 1.5, 2. A couple people answered the question all three ways. It must be fund of funds. Okay, very good. Welcome again. So why don't we do this? Ryan, if we can ask you to start off with your name, a bit about your firm, and pick one strategy you think will be really compelling for the investors in the audience the next 2 to 3 year cycle.
Yeah, sure. My name is Ryan Craig. I'm a partner leading the consumer and e-commerce practice at Bertram Capital. Bertram was started 8.5 years ago to do lower middle market buyouts with an intense growth focus thereafter. I think we're unique among firms, private equity firms, maybe even VC firms. We have a software development team working on staff at our funds solely for the benefit of our portfolio companies. It's 30-ish people now running everything from application development to social media, online marketing, you name it. And that is infused in every investment we make today. My strategy for what works, obviously lower middle market buyouts is where we've planted our flag. In particular, for me, we are seeing a lot of success. I think we will continue in buyouts of niche e-commerce businesses.
We'll come back and dig in more on justifying why you like that strategy a lot for the audience. Let's move to Philip.
Yeah, my name is Philip Vitale. I'm the Chief Investment Officer of Filament LLC in Seattle. We're a multifamily office working with very high net worth individuals and families, and working across the spectrum of capital markets, obviously, but private capital is a particular focus of ours. In terms of the strategy we're looking at a lot of kind of more niche strategies, and I think in a time in the capital markets where we're more or less panning for gold instead of trying to mine massive veins, there's a number of strategies that we're interested in, but technology growth equity is certainly close to home for us, being in Seattle, and we understand that there's a number of underappreciated opportunities in that area that are often overlooked. So,
great. We'll dig more into that in a moment as well. We'll move next to Mike.
Sure. I'm Mike Elio. I'm a partner at StepStone. I'm also co-head of the global mid-market team and the global distressed research teams that we have at StepStone. StepStone is a global advisor and asset manager. We've got about $60 billion in AUA and AUM, and we will place this year about $8 billion into about 175 managers. The space that the theme that we're following with some of our LPs is active portfolio construction strategies, and I guess we'll talk about that in a minute.
Great. And Don.
Yeah, thank you. I'm Don Vollum. I'm a managing partner and co-founder with Vista Ridge Capital Partners, and we're a private equity firm based in Portland, Oregon. We build portfolios of private equity fund interests in buyout, special situations, venture, we try to look at it globally. We have both a traditional fund of funds and some individual mandates. And the area which I think is interesting is life sciences venture.
Great. We'll have some counterpoint with Peter Thiel in a moment
Yeah.
with Don's thoughts. So, Ryan, you would propose that one strategy that will have superb risk-adjusted returns the next two or 3 years is maybe small, middle market, and a couple sectors. Talk with the audience a bit more about that, and then step out on a limb. What type of return do you see for that strategy?
Am I allowed to say that? Look, I think in the lower middle market, you have problems of selecting risk. You have adverse information. You have lemons that will come to market when the time is right. And there's pattern recognition that is extremely important, obviously, in everything we do, but especially at the bottom of the middle market. We as a firm will see just under 1,000 opportunities in profile this year, and we might invest in 2. I think I'm bullish in sectors where I see companies of a certain ilk moving into our target range that maybe in the past had been targets for VCs or are emerging businesses still founder run. And I mentioned e-commerce as one example. There are others. We're seeing businesses that have been founder run, never taken institutional money, achieving 50, 60 million of revenue, and have been online for 10, 15 years. We think there are attributes of businesses that give them defensible barriers against the behemoths like Amazon in certain situations. But it's important to know, as I think we are beginning to have a pretty good feel, what those attributes are. And in terms of what returns can we get, I don't think that's wise for me to say. I'd say we're seeing, as a rule of thumb, that we can double to triple the top line of the business by being better at running e-commerce businesses within our fund. And that's consistent over 4 platforms we've done so far.
Great. And then, Philip, you shared with the audience a conviction towards the arena of growth equity, particularly technology growth equity.
Yeah, we think that there's, we look for particular segments of inefficiency, which we find in pockets across the capital markets. So we like managers that are trying to take advantage of those pockets. Generally, a confluence of skill sets that are hard to replicate. That's kind of some of the defensibility of the particular strategies that we're looking for. And the confluence of those skill sets, I think, in growth equity and technology are particularly prevalent right now. And the opportunities are there as well. There's a lot of, I'd say, small to mid-sized companies that maybe they've been overlooked because they don't have quite the growth rate of some of the, maybe hotter segments. And there's companies that have had very limited interaction with VCs, but they've got a great potential business model. They just need individuals who've got a lot of experience in the sector, strong teams with a lot of internal kind of operational capabilities at the GP level to really kind of unlock that value, turn that business model into something that can be highly profitable, even if maybe right now it's in kind of like a slow to mid growth rate. So we think that there's lots of opportunities at the individual company level. Finding that confluence of skill sets to really locate and source these types of opportunities is key. The networking effect at the sourcing level is particularly important. And then kind of recognizing the potential, the actual optionality of these particular technology companies is usually one of the things that many other investors have overlooked. Maybe these companies are just looked at as like slow to mid growth, or they're in maybe a sector or segment that's slightly out of favor or just is underappreciated, or they're just maybe addressing a market that's not recognized as being massive. So like the larger growth equity or venture shops are really just going to it's not going to move the needle for them. So we like these kind of niche type strategies. We think tech growth equity is a really interesting spot to be kind of fishing in those waters today.
And we'll follow up in a minute about fund sizes and how that might impact strategy and potential returns in a second. Hey, can we move to Mike? You had introduced the concept of being a bit more active. What do you mean by that? And can you share a couple crisp examples of what do you mean to be active in these illiquid space?
Sure. After the global financial crisis, a lot of LPs looked back at their portfolios and really had no control about what was going on and wasn't even sure what was in them. So this time around, as we're kind of looking at an environment that we've all seen before, multiples are very high, there's a lot of capital flowing into certain areas. LPs are looking for a way to get more control over where their dollars are being spent and where they're being allocated in concerns to their entire portfolio construction. So in this world, actually, Marek and the prior panel explained it pretty well. More than twice as much capital is coming back than is going back out. So you need to be very careful where you're allocating your dollars going forward. You don't want to chase something that is too hot, but there are opportunities across a broad spectrum. So what we're working with our clients on are more targeted strategies, whether it be secondaries. The secondary market is very pricey at the moment. So if you have some things that you can sell for a great price, now might be the time to sell. If you think about it, you got into a fund, it took you 5 years to get to 1.5x. It may take you 3 more years to get 0.2 more. So if you look at that from an opportunity cost and you can deploy those dollars somewhere else and get another 1.5 somewhere else in that same period of time, it makes sense to take your money and move on to somewhere else. The other area that we're looking at is co-investments. Right now, when we're looking at managers to invest in, some of the purchase price multiples that we're seeing are well into the double digits, and it's reminiscent of something we have all seen before, and it did not end very well. Co-investments are a way for investors to control their dollars in a more targeted fashion to a specific strategy, specific sector, and at a multiple that they may actually agree with. So those two active portfolio control strategies are something we're focused on.
Great. And then Don, you'd mentioned to the group an interest in life sciences, biotech on the early stage venture side. Talk to us.
Yeah, I think that there are some great opportunities there, and Peter Thiel earlier made some criticisms of it, which actually I tend to agree with if you understand where he's coming from, which is as a Silicon Valley tech-centric guy. Because he said, well, there are a lot of regulatory uncertainties, which he's not used to, and their scientists are bad business people, and a lot of those things are true. That's why I don't invest with tech-centric guys, venture capitalists doing life sciences. You have to invest with managers who have experience in that space and who that's what they do. And in fact, I would argue that Silicon Valley and this area right here is not the center of life sciences investing. It's a bit to the south, down towards San Diego. So I think that the perspective is a little bit different. But I think that I think that a good GP has to understand how to approach these things as a business. So it is true, scientists do tend to fall in love with the science, and you can't do that. You have to understand what the business case is and what the business characteristics are. And you have to look at that from that perspective. The science may be great, the compound or device may work perfectly, and yet it may still be a terrible business. So I think that there are huge opportunities which are being created right now by a combination of things, by big data, by the speed increasing of and automation of some of the research techniques and some of the drug development techniques which are happening, and simply by a confluence of greater understanding. So I think it's a great space. There is not as much money flowing into it as some of the other spaces. You don't see the big dollar exits, and yet from a returns perspective, I've seen some studies that if you take out some of the bubble era returns on the tech side, life sciences has been very comparable. In fact, arguably has beaten it. So I'll throw that out there.
So we've shared with the audience 4 strategies that our panel think could be compelling in the next cycle. I'm going to ask the panelists to talk about 2 additional ones, and then we'll flip the coin over and talk about strategies to avoid. So Don, if you were to add 2 in addition to life sciences, which you advocated for, which other 2 would be near the top or certainly on your radar screen to commit capital?
Well, I think that one space which is really interesting is frontier markets growth equity. In particular, places like Africa, you have to be very careful in terms of where you pick your manager and you pick your geography and what they're doing. And of course, there's a lot of bad news about Ebola and all that kind of stuff, which actually from an investor perspective is not a bad thing because that dampens the interest and it makes for better opportunities. You also have to understand that when you're investing in frontier markets, as a Western investor, I want to invest with guys who are going to give me a Western level of transparency and governance. And those guys are not necessarily the local guys who may generate the top returns, but I think I can still participate very actively in those returns. And so I think that's a great opportunity. I wouldn't include all frontier markets in it because I think there's some real dangerous ones in Latin America. I don't think I'd be investing in Russia right now, but I think Africa in particular is good. I really only had the one, so I'll
That's okay.
pass that on.
How about you, Mike?
Sure. We're still focused on the lower and mid-market space, especially here in North America. It is such a wide and deep area of general partners and opportunities. So there are actually some managers out there buying companies at mid-single digits still. So there's a lot of room for some value creation there. On the other side, we're looking, Europe is going through some great change with the AQR coming through. A ton of money has already been raised for distressed investments in Europe. We're avoiding that space. There's already too much money there, but we're looking more in the stress space. So it's the area of performing loans that are right on the edge. A lot of the European banks are going to have to unload a lot of this stuff as well. So those are the two areas we're focused on right now.
And Philip, two additional strategies you're looking at for good returns this cycle.
So areas that we're diligencing that would be supplemental, what I mentioned earlier, are probably going to overlap a little bit here. We've spent a fair amount of time on the co-investment side. We've actually done multiple dedicated co-investment vehicles, and obviously you can do the co-investments in venture, buyout, actually crossing over into the hedge fund side as well. And we've actually made a significant amount of profits for clients over basically since the crisis in that area. So we're still very interested in co-investments. Of course, there's a lot more competition now, so maybe a little bit less attractive, but I think it's an area that's still ripe for the picking with the right partners. And then to kind of ditto Don, we've been spending a fair amount of time doing frontier and emerging markets, private equity work. And we're not, we probably split our assets about 50-50 between fund of funds and actual direct fund investments. So, these are areas where, with the right fund-to-fund manager too, you can actually do quite well, get diversification, a whole nother layer of risk management and work. And for us, Frontier EM is very interesting, but we don't really want to pick a single fund or just a couple to do that work in, so we're more interested in a couple unique fund-to-fund opportunities in that area.
Ryan, you're the representative GP on the panel, and you shared with the group your focus and your firm's focus. But if you had extra personal money to deploy outside what you contribute to your GP, where would you put your dollars?
Well, when I look around at other firms that I think highly of, which is my best lens on this, I have a lot of respect for the great dedicated consumer firms. I think you said in the last session that you're seeing a lot of success there. We're seeing it as well, even in retail in some cases, especially with a small footprint, where the unit economics are known and proven over 10 or 20 units. That looks to be a pretty good model to keep pushing out units. And secondly, aggressively buying and building on the industrial side. We have some success doing that, but I'm looking at other firms in the middle market, lower middle market, who are aggressive of being active, building around a good management team. There tends to be a very well-capitalized set of strategics making acquisitions in that space, and if you get a team that sort of knows roughly what the strategics are looking for, there's a reasonably predictable path to exit that we're seeing.
That's great. So on the other side of the coin, and part of the title of today's panel is which strategies to avoid, which are not hot, which ones will have, in your opinions, less compelling returns. Hopefully they'll have positive returns, but you might be dialing down or maybe ignoring those strategies. So maybe, Mike, we'll start with you. If there's an area that you're less keen on, you're less hot on, based on potential returns, what would be on your list?
Sure. I already mentioned one, that's the distress space. We think a ton of money is poured into there. That doesn't mean we're not committing in that space. With the amount of money that we have to deploy, we have a mandate from someone across our client base to invest almost anywhere. We're just being more cautious in that space. The other is in Latin America. With the FX issues that external investors are having, we're being very cautious with manager selection in that region. It's not to say we're not deploying dollars, because we are, but we are being much more selective as we do.
Philip, what about you? If there's a strategy or two you might dial back on or less interested in, what would come top of mind?
Well, there's one area that kind of reminds me of a little bit of the clean tech fundraise, kind of in 06, 07, which gave us a little bit of heartburn. Unfortunately, we didn't do anything there, but seeing similar pattern in the direct lending space. Usually, lots of competition and probably, I'd say, a more efficient space than what people actually understand or believe that to be. So I think we're probably getting, half a dozen to a dozen pitch books in direct lending today from managers across GPs across the U.S., mostly undifferentiated pitch books, undifferentiated strategies, often with a significant amount of leverage and not a lot of value add. We like people that are going to roll up their sleeves, get their hands dirty, and add value at the underlying investment level. And I think it's a lot harder to find someone that fits that bill in kind of the direct lending space. And no doubt there's an opportunity for folks to make considerable profits in the disintermediation of the banking system and how that's evolved. But you got to be just laser focused, I think, if you're going to invest in a GP and a fund in that area. You're probably going to discard 99 out of 100 ideas.
And Don, yourself, strategies that you want to dial down or maybe ignore?
Well, I think it's important in private equity to point out that in every strategy there are great managers who can do very well. And so if I point something out, somebody will say, well, but there's this great manager who's killing it over here, and that's true. So that is how it is. I think personally that the hardest place to make money right now is probably in secondaries, because there's so much money that has flowed into that. The pricing has become pretty outrageous. It's difficult to see, especially in the larger guys. There are some smaller differentiated guys who may be able to do okay, but even there I think the pricing is flowing downhill. So I think it's very, very difficult to make money in a space like that where there's so much money has flowed into it.
I'm going to ask the audience to fire questions to the panel, especially the three allocators on the panel. And as you're thinking about your questions, I'm going to put Ryan on the spot again. And with his limited personal resources, where do you not want to put money? You said where you might put it. We heard your response.
I'm scared right now of distressed funds and middle market buyouts where leverage has flowed into places it hasn't flowed. I think there's an illusion of stable cash flows right now, and that tide will recede, and I wouldn't want to be the equity sitting below the debt.
Great. Questions for the panel? Yes, sir.
What about large cap buyout? Nobody mentioned anything about that as an area they want to invest in, and nobody mentioned that as an area they don't want to invest in.
Yes.
Well, I would start by saying that generally those guys have generated decent returns, and I wouldn't say that I personally don't have a problem with them. I don't see them outperforming massively, and I don't see them underperforming massively either. So I think there's nothing wrong with investing in them, but the point was hot or not, and it didn't really fall into either category. That's my view. You guys might disagree.
No, it makes sense. I mean, to follow on that, the large buyout space has become the beta of our asset class. So a lot of folks are looking at co-investments at that end of the market as a way to get more exposure and hopefully get a little bit more return.
Yeah, go for it.
And I agree with you, but large market buyouts and beta, why do people pay the fees to access it?
Why pay fees?
Why pay those fees to access what's effectively beta in the market?
Well, an interesting fact is that the large buyouts are typically lower fees than the smaller to mid, so you could argue they're paying less, right? And I think that it's probably fair to say that the fees are lower typically than in the small to mid space. And I think factoring in, I think your beta as an after fee would be how I would look at it. So I don't think there's a correlation between paying higher or lower fees necessarily in performance.
Yes, sir.
One of the gentlemen mentioned about sort of co-investments and how you co-invest with managers. I'm just curious, if you enter into a co-investment, be it a public position or a private position with a manager, do you compensate that manager for co-investing with them? Or
Compensate the manager?
Do you compensate the manager and say, okay, we'll pick out this co-investment idea for you, say in a public equity, we'll trade along, we'll structure the same trade as you, and we will give you a performance fee on the upside or anything like that? Or do you see it as an addition to a 20 or 150 you pay for the manager?
I don't know how you do it, but we don't pay fees and carry on co-investments. We tend to, 85% of the co-investments we do are actually co-sponsor, not syndications after the fact. So we're there right at the beginning of the deal alongside the GP as a partner. Instead of the GP calling another GP, they'll call us instead.
And that's pretty consistent for us, too. I mean, we're generally not making a lot of direct co-investments ourselves. Oftentimes we're participating in, let's say, a dedicated co-investment fund. And oftentimes that fund is getting deals in the same way. It's not paying kind of a typical 2 and 20. Usually it's getting those for free alongside other investments that GP is making in other parts of their business. And sometimes those co-investments will be like an SPV that charges some kind of fee, but it's usually going to be something substantially less than the traditional kind of 2 and 20 overall fund model. And we will pay fees at the fund level to be in a dedicated co-investment fund, but of course we're kind of weighing those against what we think the potential value proposition is for the co-investment piece. And I think if the co-investment, the manager making the co-investments on our behalf within the context of that fund is doing what we want them to be doing, then we should be paying fees for that to a certain extent, to compensate them for their extra effort, their access, and the value add that they do in the evaluation of those co-investments and the aggregation of them into a somewhat diversified fund structure for our clients.
I'd like to just add something to that, though, which is that I have seen some that have come where they wanted a fee. So I think a few years ago, the answer would have been clearly obvious. I've never seen this. It's purely no fee, no carry. And it's now a topic of conversation, at least.
Yeah, there's probably upward pressure on there being more fees associated with these opportunities, I would say.
Additional questions to the panel? With 1.5 exceptions, there aren't big secondary providers in this room, and a couple of the panelists hinted that maybe some of the pricing in secondary markets, if you're an investor with dry powder, kind of expensive. But what's driving that, and what's going to change that?
Well, since I knocked on secondaries, I guess I'll answer that.
Thanks, Don.
I think that what's driving it is the flow of funds, and that's being driven by the great returns that secondaries funds have generated in the past. So I think it's return chasing. I think there is, however, a structural element, which is that more and more managers are using active portfolio management, and they're using the secondary market to manage their portfolios. So I think that explains a piece of it, and that in fact explains greater supply. That enables it to at least absorb the capital that's flowing in. But I think the bigger piece of why the capital is flowing in is really returns chasing.
With that, I'd like everyone to join me in a round of applause for this very helpful panel. Thank you. Thank you, gentlemen. Good job.